All right, we are getting some important information. SEBI chairperson Madhabi Buch is addressing the media on crucial board decisions. Let's cut across.
The area of their operations is really to act as a first-level regulator. So they not only need to be very careful about their own compliances with the regulations, but also to look at the compliances by the registered brokers, by the registered DPs, by the listed entities. And it was the committee's finding that perhaps these three different roles that the MIIs have were not getting adequate and equal importance. So a lot of what you are seeing as the manifestation of the working committee's report is that each of these three pillars of the role of the MIIs to function as a profitable, viable commercial entity, plus provide public infrastructure, plus function as a effective first-level regulator, all these three things need to be delivered. So that is really the central thought, and it is reflected in almost everything that you see here, whether it is the proposed structure of MIIs, the nature of board governance, the accountability of the KMPs, the code of conduct, and this is, an important piece you would have noticed on page 3, item number 12, that board members and KMPs will be held accountable if they are aware of wrongdoings but have not appropriately reported the same. Because you're not just another entity, you're a market infrastructure institution, and if you become aware and you do not report, then you are complicit. So this is a very important part of governance and code of conduct. And overall, therefore, the objective is that this should bring in much more balanced operations of the MIIs with a lot of transparency and accountability. We then move on to item number 2, which is the buyback of securities. I think that has already attracted a lot of interest. I think somebody in the media reported that SEBI has picked out its favorite mode, and which is true, because we feel that the tender route is the more equitable route to buyback, and that the other routes are vulnerable to favoritism, let me say, because nobody really knows that in the exchange mechanism, when is the company going to come in order to buy back the shares, and only a few people may be aware of it, and benefits may flow to those few people. It is not an equitable mechanism. And in that context, we are therefore seeking to phase out the stock exchange route for buyback. But in the interim, since we don't want to have any knee-jerk reaction to anything, and we have given a glide path, in the interim, we propose that there will be that minimum utilization of the earmarked amount should be increased from 50% to 75%, which means that if you announce a buyback, you must at least do 75% buyback. And also that there will be a separate window on the stock exchange. It cannot be nebulous, and it matches with just anybody. There is a separate window for buyback. And that will also assist going forward in terms of identifying the tax-related issues, which are important in the whole buyback mechanism. The tender offer route, we are trying to optimize by reducing the timeline, and you will notice that one of the things that we have done, in SEBI, we've spoken about ease of doing business, of business process re-engineering, and you would have noticed on page 4 that we are completely removing the requirement of filing a draft letter of offer with SEBI and awaiting our observations. It's just eliminated. So there we believe that, this is a already listed entity. It has ongoing disclosure requirements. They are making public their intentions, and there is no need for SEBI to have any additional requirements or to make any additional observations, and people are expected to comply with the laws of the land. So removing altogether the requirement of filing and observations, which saves time, and also cutting short the tendering period and the period requirement for payment. We have now all digital payment mechanisms, so there's no reason for it to take so long. We are also permitting upward revision of the buyback price right up till 1 day prior to the record date. Right? And why the record date? Because naturally, if somebody is taking a decision on the basis of the buyback price, then he needs to know that before the record date is recorded and the cutoff is made. There's also some mandatory dissemination of information that is in line with our usual philosophy of disclosure and transparency. And overall, we hope that this will really streamline the buyback process, also create a level playing field for all investors once the stock exchange route is phased out. The third is a very important piece of regulation. It is facilitative in nature. In the mutual fund industry, as you know, that right now all the online platforms are either registered as brokers or investment advisors, and they need to comply with a very large set of regulations which were never really designed or intended for somebody who is offering merely an execution platform for direct plans of mutual funds. So therefore, the thought is that we will create this new category. And in this new category, people will then be free to be able to offer this facility, which has anyway become very popular amongst investors, to go online and to directly invest in direct schemes and direct plans of mutual funds. But the offerer need not comply with a whole host of either broker regulations or investment advisor regulations. They comply only with the specific regulations related to execution-only platforms. So hopefully this will make it a lot easier for people to offer this while complying in a very convenient way. Of course, also we have brought in the whole concept of investor protection into this whole framework. Essentially, the advisory committees on this subject and the consultation papers, there were two models which were proposed. We finally decided that we as a regulator don't need to pick favorites on this one. We are okay. The first model, which is called Category 1, is where the platform operates as an agent of the AMC. So he gets paid by the AMC, he has a contract with the AMC, and he's functioning as an arm of the AMC, registered with AMFI, because the AMFI is the sort of a trade body for the AMCs. So they will not register with SEBI at all. They will be treated as agents of the AMCs, and whatever regulation we need to do will be via the AMCs. The second model is Cat 2, where the execution-only platform is an agent of the investor. And then he has to be registered as a stockbroker, but this will be a limited purpose stockbroker so that he doesn't have to comply with needless regulations. And here they will be registered with SEBI. SEBI will give the registration and the investor will pay because he's an agent of the investor. So both models will be available and people will be free to pick whatever works for them. The next item is very, very critical, I think, to us in SEBI. While we celebrate technology and all that it can do to democratize access to the markets, we also worry about cybersecurity. We also worry about disruption of trading services, not every time because of cyber attacks, but simply because when businesses grow very large and the technology begins to become a little dated, it doesn't always hold up under pressure. And we worry that particularly where this risk is concentrated in terms of some of the large brokers today that we have, then the investor is left with no alternative. If his broker is down and his position is open and the market is volatile, he is very, very vulnerable. So the objective here is to provide a mechanism for such investors to come directly to the exchange to close out their positions and to close their and to cancel their orders. So this direct access will be facilitated only and only for risk reduction. They cannot increase positions while their broker is down. But if the broker is down for a certain period and there is a mechanism that has been described, then this alternative mechanism comes up and people are free to come, access their positions in the market, close them out, close their pending orders so that risk is reduced. So it's a risk reduction access to investors, and this can be triggered either at the request of the broker himself because if he goes down and he sees that it's unlikely he's going to be able to come up soon, he can request the exchanges to trigger this. Or even if the broker does not request, but suo moto, the exchanges feel that this has been taking too long, the broker is not able to come up, it's a volatile day, then they can automatically, or they can suo moto trigger this facility and let the investors know that they have an alternative option to come here and execute their risk reduction trades. This would be a first across the globe. It's a very, very important initiative from our perspective. It will require building of systems and execution. So we expect that roughly in the third quarter of 23-24 is when this will go live. But all the planning and the working and the building will happen in the interim. Next item is a sort of linked item in the sense that it talks about stockbrokers who will henceforth be designated as qualified stockbrokers. You're probably aware that 3 of our RTAs, that is registrar and transfer agents, are called qualified RTAs because they handle very, very large volumes of investor data and transactions. And they have certain additional requirements which they have to comply with over and above what regular RTAs have to comply with. So similarly over here, in order to address the concentration risk which exists in our market today, there are, as you know, for instance, the top 10 or top 12 brokers will account for very, very large percentage of the market volumes. So in order to mitigate the concentration risk, what is proposed is that on the basis of some very transparent criteria, first of all, certain brokers will be identified or designated as qualified stockbrokers, and there will be an enhanced requirement on them in terms of risk management, of course, all types of risk, market risk, IT risk, cyber risk, etc. Much higher standards will be expected of them. And there will be a higher obligation on the MIIs and on SEBI in terms of monitoring them as well. So for instance, in terms of our inspections, etc., frequency of inspection, regularity of review, etc., all of that, there will be a greater responsibility on the MIIs and on SEBI as well. The next item is relating to FPIs. As you know, we had a few months ago constituted a dedicated standing committee for FPIs to be able to focus on their requirements. They are an important stakeholder in our markets. And one of the first things that they wished us to take up was to have an easier onboarding process and a registration process. And based on the recommendations of the working group that was constituted under the aegis of that committee, a number of recommendations have come, including processing of papers based on scanned copies, digital signatures, SWIFT mechanism to get confirmations from overseas bankers, and so on. Certain risk mitigation measures are also in place, so it's not as though only scanned copies will be used. The plan is really because they need a number of registrations and accounts to be opened. So what happens is that it all becomes sequential and everything has to wait for the next thing. Whereas the plan here is that once you are relying on scanned documents, you can do a lot of things in parallel. But the final activation of the accounts will only happen when the physical documents come. But still, in the meanwhile, you've been able to do many more things in parallel. So this is expected to bring down the time required for FPI registration and also to facilitate making it more easy. The next one is in respect of green bonds. As you know, this is going to become a very key area of finance for all countries. And it is very important that we facilitate finance of green initiatives while safeguarding against greenwashing. So what we have done in this regulation is to facilitate 3 or 4 things. Number one is to actually enhance the scope as compared to our earlier regulations, enhance the scope in terms of the definition of green debt, and bring in new proposals, for instance, in terms of pollution prevention, pollution control, eco-efficient products, etc. We've also introduced the concept of blue bonds, which relates to water management and the marine sector. And as you know, going forward, a lot of carbon credits can be generated not just from the forests in the country, but from the marine resources that the country has. So this will become very important once we move into the carbon credit area. Also, yellow bonds related to solar energy and transition bonds or transition finance bonds, which, as you know, are forms of finance which are targeted at helping companies which are in an area of high carbon impact and assisting them to transition to low carbon impact. So each of these areas is very important to us, but at the same time, we also needed to address certain greenwashing related risks. And this is something that also we are proposing in the regulation. As always, a glide path approach is being adopted. And time is being given to existing issuers because they're already there, they've already raised money in order to have a smooth transition to this regime. The next item, number 8, is again developmental in nature, ease of doing business, greater flexibility to the AIFs. So here what is proposed is that the AIFs, who up until now were only permitted to buy protection by way of CDS, will now be permitted to sell protection by way of CDS. And this is bifurcated depending on the category of the AIF. So category 1 AIFs, which are meant to serve a somewhat different social and economic objective, will still be permitted only to do hedging, which means only buying protection. But Cat 2 AIFs, which are the largest category of AIFs in our country, they will be permitted both to do hedging as well as to sell CDS. The construct is really in the nature of a synthetic bond. So basically what will happen is the AIF, let's say they have 100 crores and they want to create a synthetic bond on corporate XYZ. They will actually buy GSECs worth 100 crores, but then they will write or sell protection on company XYZ, and the two together will constitute a synthetic bond. So on the other side, whoever is the buyer of that CDS will get protection against that particular issuer. But on this side, the AIF will basically treat this asset like a synthetic bond, since its money, in the event it is ever called upon to honor that CDS, it will have the money to honor it because he can go to the market, sell the GSEC, and honor his commitment. Category 3 AIFs have even more flexibility. Not only can they, of course, buy protection and sell protection in the form of synthetic bonds, but since intrinsically they are permitted a certain amount of leverage, so they are allowed to write protection without the underlying GSEC as well, because it will be counted as in the nature of leverage. So there's even greater flexibility for Cat 3 bonds. So we believe that this flexibility to the AIF industry is important, and also from the perspective of the development of the bond market. We think this is also an important step. More and more players, if they come in and participate in this market, it will only be good. The next point in terms of number 9 is in terms of streamlining certain requirements for debt issuers in the country. As you know, the debenture trustees are the custodians of the interest of debenture holders whenever there is a market issuance of bonds. They have expressed concerns to us that in the event of a default, when they seek to be appointed on the board of the company, then that does not happen very often. And therefore, the amendment that we are bringing about is that the issuers will need to amend their articles of association so as to cast an obligation on the board that in the event of a default, which has been defined, the person who is nominated by the debenture trustees must be appointed as a director. So this will give more teeth to the debenture trustees in order for them to fulfill their obligations towards their investors. Also some streamlining of timelines. Number 10, REITs and InvITs, as you know, these are relatively new instruments, hybrid instruments in our markets. And at this stage, we have had extensive discussions and interactions with the industry. And based on a lot of that guidance and inputs, we have introduced various governance norms for REITs and InvITs, which is covered under item 10, much on the lines of our LODR requirements for listed companies. But because the nature of the instrument is different, certain carve-outs and dispensations and adaptations have been done for REITs and InvITs. Similarly, item 11 also relates to certain provisions which needed to be streamlined, again, appropriately adapted. One of the important things, of course, was unclaimed, unpaid dividends, which we also hope should not be high, but in the event they are, then there is a proper way of dealing with it. The last item is the framework for adoption of cloud services by SEBI-regulated entities. This is a principle-based framework that we have brought in. And the objective really is to ensure that all our regulated entities address the issues of risk assessment, regulatory and legal compliances, have very clearly articulated rights, responsibilities, and accountabilities and sharing of responsibilities contractually with their cloud service providers. And also, at the same time, giving SEBI and other government agencies the right to access the data which is stored in the cloud wherever required, whenever required, in terms of any investigation, inspection, audit, etc. So the objective really here is to give the benefit to people. You know, some of them, they were hesitating to go on the cloud. They were not quite sure what was SEBI's views on this. And so the objective was to clarify that, yes, you can use cloud services, but naturally there is a lot of risk mitigation that you need to do in terms of protecting sensitive information that belongs to the investors. So this is a broad summary of what has kept us busy in the morning today. Happy to take questions.
Thank you, ma'am. We're open for questions. Yes, Yash, CNBC.
Good evening, ma'am, and to the board. I'm Yash from CNBC-TV18. Before I ask my question, I just want to have a little clarification. As far as the consultation paper on the tender route for buyback is concerned, it had a couple of more points. I mean, just to name a couple of them. The maximum limit was about 40% as compared to 25%. Also allowing two buyback offers in a year for net debt-free companies.
That's correct.
In the paper that we have in front of us, those couple of points are not there. So
that's right. Because so the purpose was to get feedback from the market on the need for such a relaxation, etc. But as you know, those restrictions are governed under the Companies Act. They are not governed by SEBI. So therefore, first there has to be a proposal from SEBI to MCA to say this is what the market is desirous of doing. And therefore, can you consider relaxing those? And then in consultation only if that happens. So there is no point in our giving our approval when anyway there's a constraint from the other side. And the second is also that the consultation paper spoke of tax problems, right? As you know that our current provisions are not very fair, right? Peter pays for Paul's tax. Now that's not a very good idea. So therefore, we are also engaged with the ministry to discuss as to in what way this can be sorted out. So these two things will go hand in hand, that resolving the issue that Peter should not pay for Paul's tax and the Companies Act, relaxations will go hand in hand, and we will take it up at the appropriate time once we build consensus.
Okay, now to the question, and this is with respect to the primary market. In the recent past, we've seen approvals going all the way to over 100 days once the DRHP is filed. I mean, are you of the view that this has to be reduced and for whatever reason it's gone beyond what it should not be? To your sense, what should be the ideal time that you are looking at as far as approval is concerned? And for whatever reason, a lot of times from the side of investment bankers, also merchant bankers, there is a delay. In that case, for no fault of yours, the issue gets delayed. What does the regulator do in such instances?
आपने तो सब ये सब पहले ही मीडिया में खूब छाप दिया है, सभी कुछ बोलने की बात बाकी बची नहीं है, पर तब भी मैं कह दूं, clearly I think there are two objectives that SEBI has. I have said this, those of you who are aware of my statements when I attended the Association of Merchant Bankers meeting, that as you know, I've been a merchant banker myself, and therefore I understand that timing is everything. And for a client, when they want to raise capital, if for any reason the timing is missed, it is a very, very serious issue. And it is our desire that SEBI should never be the reason why the client misses timing. There is enough data that we have to show that there are some merchant bankers who are repeat offenders. What do I mean by repeat offenders? They bring one document to us. We say, here are the 25 lacunae in the document. They go back, they take a lot of time, they come back with incomplete papers. I think it's a desire to tell their client that we have filed with SEBI, but comprehensiveness, neither the client asks or anything, and then the question is that it's all a question of, it's being footballed within, back and forth between SEBI. But where was there the transparency as to exactly how many lacunae you had? And what do I mean by repeat offender? Same merchant banker comes back 2 months later for another client and has the same 25 lacunae in the document. मतलब आपने कुछ सीखा नहीं, एक बार सेबी ने बोला है और वो एविडेंट है आपको, तभी भी आप वही के वही, and then not just second time, third time, fourth time. So I think our objective is that, look, we fully own delays at our end, but the merchant bankers need to fully own delays at their end and inadequate papers that they submit, and simply to show the client that they have filed papers with SEBI will not work now. So we will clearly have a process with full transparency. And as I said in that meeting, we will introduce a concept called returning the papers. It's not a rejection. We're not rejecting it. But we are not accepting it. And we are simply saying, this is incomplete. Please refer to our checklist. Please refer to our FAQs. And please submit complete papers. If it's not complete papers, our clock won't start ticking. So now it's up to the merchant bankers that why is it that every time they come with a different client and they have the same 25 lacunae, hopefully that problem will go away. So we have to do our share. The industry has to do its own share. But we have a shared objective on behalf of industry who needs to raise capital that you cannot have delays. Now, with the new processes that we put in place, it will become very clear as to where the delay really is and where the inadequacy is. And I'm committing on behalf of SEBI today that we will work very, very, very hard to make sure that there is no delay at our end.
So will you be disclosing it in the sense that the papers have been returned?
Yeah.
Yeah.
We will return.
ET now.
Ma'am, related to buyback regulations, I wanted to know, when you say you want to phase out stock exchange route, is there any timeline do you have in mind?
Yeah, we've stipulated it. Someone can answer. Yes, Mr. Ram.